Hey guys, if you're an Amazon seller, you know that cash flow is the lifeblood of your business. So whether you want to scale your business even more, you want to free up some cash flow, or you just want to offset the tariffs and you want to buy some more inventory before the tariffs go up again, today I have a special guest, Ben Kosh from Accruemy. He's going to walk you through ways that you can get additional cash flow, lending to inject that into your business so you can really crush it in Q4. So welcome, Ben. How's it going?
Hey Gary, glad to be here. Thanks for having me.
Yes, it's great to be here. So Ben is the co-founder and president of Accruemy. They're providing innovative, success-based financing solutions for Amazon sellers and e-commerce retailers. So, as of right now, 2025, given the state of the Amazon business, I mean, you work with a lot of sellers, medium to large size sellers, and you know that they're dealing with a lot of uncertainties with the tariffs, with, them being up and down, and like all the news and all that. I mean, why is this so important for sellers right now? I mean, in terms of like lending, funding, and cash flow, and who's this for today?
Yeah, so I think right now a lot of sellers are trying to get ahead of tariffs specifically and the changes in tariffs. So having some extra cash flow or an investment partner who can inject extra cash flow quickly when these things change on a dime, as it seems to happen these days, has been pretty helpful. Also, a lot of sellers with just the way that Amazon's been over the last year, the way that they've kind of seller support's been a little bit worse than usual. Not that it's ever been great. Um, but more suspensions, more issues like that. A lot of larger sellers who have maybe a couple $1 million of their own cash tied up in their business and want to take some of that cash off the table and bring in an investment partner. And then there's also a lot of larger sellers in particular who have loans, or I'll just call them financing agreements, with investors or lenders whose programs are really more designed for smaller, higher risk sellers, and that makes them really expensive. So you're draining your cash flow and paying a crazy APR to some of these lenders because you're using financing that's meant for smaller, higher risk, higher growth businesses, and you're using that to finance a larger business, and maybe you're realizing that you're actually taking on money, but it's leaving you in a worse cash flow position and basically draining your bank account every month. So those are probably the few groups of people that this would be for and why this is relevant today.
Yeah, that makes a lot of sense. I mean, especially with the rapid nature of all the changes we're seeing on Amazon, and especially on the tariff side. I interviewed a 40-year logistics and supply chain expert. I mean, this Dan Krasenstein. He's been doing sourcing supply chain. I mean, in China, in India. He said, like, right now he's never seen it in his 40-year career, like just the volatility of all of the changes, the tariffs, and he kind of used this like basketball analogy, like we're kind of like in defensive position right now. We're just like reacting, like whoever can is the most agile, like whatever Amazon business is the most agile is the one that's going to come out on top in the end, right? It's because everything is changing so rapidly. So I mean, speaking of changes, I mean, people know that Amazon has changed their their lending and their loans, and previously Amazon was out offering loans that they would offer sellers based on your sales history, but as far as I understand, that's now gone, right? So Ben, what can you give us the update? I mean, how has Amazon changed, and what are you guys doing about that?
Yeah, so I guess Amazon used to be a direct lender. They had about $1 billion out in sellers, and they've really pulled back on that and basically stopped lending altogether, stopped offering refinancing, and instead they promote a few alternative lenders through Seller Central that all have all the data of your account and can see everything that's going on with your account. The challenge with those is compared to what Amazon used to offer, the terms just aren't as strong. So Amazon used to offer mid to high teens, sometimes even low teens rates. Maybe an amortization schedule of 12 or 24 months for bigger sellers, and it wasn't really a terrible deal. And now a lot of the options that you have through Seller Central are things like merchant cash advances, revenue-based loans, fast amortizing loans that will really just suck out all of your cash flow. So what we kind of did, and we used to invest in smaller sellers. We would do investments as low as like $10,000 in sellers. And as the landscape has changed, and really as we've also gotten more experience investing in sellers, we've kind of decided to make a little bit of a change on our end and start offering better terms to larger sellers. So really looking to make at least a minimum of $100,000 investment, and ideally around 250,000 to a couple million in sellers, and really giving them terms that are just as good as a bank. But because we understand e-commerce, we can underwrite them faster, so we can get them funded a lot faster because we connect through APIs to all of their stores. We can really understand what's happening with their business by looking at their data and then monitoring their data in real time. So we get rid of a lot of the headaches that you would go through as, a multi-million-dollar seller dealing with a bank. And we give them the option to just basically provide us with their data, do that all really quickly, provide them real-time access and visibility into how much we can offer at any time. And then the thing that we do that's a little bit better than a bank is we don't require audits of their inventory, because we understand e-commerce and we get data feeds from their 3PLs or from the platforms where they're actually storing inventory, like FBA. We can basically offer them the same rate, but we don't actually make them make any payments at all for up to 36 months. So that could be no interest, no principal, $0 coming out of their bank account for up to 36 months, so that they can invest all that money back in the business and grow. And that's just because, unlike a bank who doesn't really understand e-commerce, who's going to require you to, send an independent auditor to your warehouses and check your inventory, ask you to produce borrowing bases every month or every week, we do that all automated. So we're comfortable, as long as we can see that the business is healthy, to just keep our money in and let it ride and grow with you. So that's kind of where the landscape is now, and how we've changed a little bit to approach things differently.
Yeah, I mean, we had your partner, Don Hennig, on the summit several years ago during the pandemic. So, I mean, you guys have been doing this since about 2018, 2019, just like specialized on e-commerce Amazon sellers. Is that correct?
Mm-hmm. Yeah, and the big difference is, we've learned a lot in that time as well. So, since we started, we were investing in everybody, retail arbitrage, wholesale. And right now we really focus on people who are doing at least $1 million a year in sales, but ideally closer to $1 million a month in sales. And people who either have their own brand or have a brand exclusive, or buying directly from a brand and are authorized to sell on Amazon. That's mostly been our focus now.
Okay, so
Especially on Amazon.
Especially what?
Especially with some of the changes with Amazon, I'm sure you saw, even with like Walmart recently, all the category gating and document requires and supply chain requests and all of that. It's just been better investment for us to invest in larger sellers who control the supply chain basically from the source.
Makes sense. Okay. So obviously you work with a lot of Amazon sellers. What are some of the biggest funding pitfalls that you're seeing, Ben?
So I think the biggest thing in general is that most sellers don't understand the terms of the loans or funding agreements that they get themselves into, and it's not really like their fault. Most of them aren't MBAs or finance experts, and most of these, especially the ones that are targeted towards Amazon and e-commerce sellers, are marketed in a very attractive way. So just to give you an example, a lot of times you'll see like revenue-based loans, and they'll advertise with a flat fee. So for example, maybe they'll say we'll give you a $100,000 investment, $12,000 flat fee, and you use 20% of your revenue to repay us. So like most Amazon sellers, are just going to think, okay, 12,000 is 12% of $100,000, so a $12,000 fee must be a 12% interest rate. And the reality is that that's not true. It's really closer to a 50 to 100% interest rate, depending on how quickly you repay. So most of these, especially if it's your first loan with one of these groups, the actual repayment could be somewhere around 3 to 4 months. So that means that even though they gave you $100,000 on average over that period, you really only have $50,000 of the investor's capital outstanding to work with, because you start making payments usually in the second week, sometimes on day one. So you don't actually have $100,000 the whole time. That's the first thing. And then you're repaying it in 12 months. So basically the $12,000 over $50,000 is 24% right there, right? If you look at it of what you actually have outstanding. And then if you're repaying it in 3 months and you have to refinance it 4 times to basically have that $50,000 in capital for a year, you're basically looking at a 96% effective APR, right? 24% for the term of each short loan, times 4 refinancings over the year, and now you're at a 96% effective APR. And that's not even to mention that all of the cash flow, right? 20% of your revenue could usually be 50+% of your Amazon deposit, and that's all getting sucked out of your business. And now you're kind of, drowning in huge payments, and your lender is actually like doubling their money with you over the term of a year. And it really just, and that's just one example, but a lot of these, financing offers are just designed to seem really simple, but the reality is that an Amazon seller who's taking one of these is dealing with hedge fund experts and people behind the scenes at these companies who are trying to get a much bigger return than 12%, especially for the risk they take on, especially if they're investing in smaller sellers as well. So at the end of the day, you're kind of, as an Amazon seller, going up against these sophisticated hedge fund guys who are looking to get an outsized return by investing in Amazon sellers, and you don't really know what you're getting yourself into, and then you end up paying for it in the end. And I've seen, just because people don't understand what they get into, we've had so many sellers even come to us looking to refinance where we can't even help them because they just get so upside down with their debt, right? If you're paying 100% on what you borrowed, and you're doing that every year, even after 6 months of that, in a lot of cases for brands with small margins, that could really leave them in a very difficult situation.
Yeah, it looks like there's a lot of these, fine print technicalities that a lot of sellers are overlooking. So one key takeaway, guys, is if you are, taking on a loan, make sure you look at the fine print, because you could be paying up to 96%, because what they say isn't actually, bottom line what you're paying out, right? You got to look at the, the time and all of the details. So Ben, talking a little bit more about the rising tariffs and the pressure on margins, obviously all sellers are facing right now, with the cash squeeze. Do you have any examples of like a seller? Obviously, you don't have to give out their name and what they're selling, but how have you guys helped them? How have you enabled them to kind of free up their cash flow to inject that into their business so they can be more successful this year?
Yeah, so we have a good example actually that I was just thinking of when we were talking about tariffs earlier. Who he's sourcing from Brazil, and they recently, a couple weeks ago, had an issue with Trump tariffs, and he was pretty panicked because that was going to drastically increase his cost of goods. So he wanted to buy a bunch of inventory in advance, and we had a little under $1 million invested with them already, and that was kind of what we were comfortable investing. But we took a look and understood his business and what he was trying to accomplish. So we basically within about 5 days, we were able to kind of give him an extra extension of another $500,000 to go and buy 3 or 4 months worth of inventory that'll hopefully, hold him over at least while some of this chaos, processes. And then at the end of the day, if he has to start paying tariffs on his future orders, he'll have to start doing that. But at least it gives him a little bit of buffer room that probably a lot of other people don't really have the option to, have, a friendly investor basically give them $500,000 in a couple days when something like this happens.
Yeah, I mean, that's huge, right? That goes back to agility, how fast you can pivot right now as a business, right? So if you're able to immediately, take advantage of the buffer before the tariffs go up again, right? If you're able to capture that inventory, through lending, then definitely you're at an advantage. You can get lower cost inventory, right, before the tariffs hit. Okay. So the other big point that I wanted to touch upon with you, Ben, is what are the types of funders and what's the 2025 landscape you're seeing?
Yeah, so I kind of break the groups into 2 groups. So I think that there's funders that invest in people doing under $100,000 a month, and then there's funders who will invest in people doing over $100,000 a month, or you could look at it like $1 million a year, but that range. So for under $100,000 a month, especially if you're relatively new to selling, you're going to be mostly dealing with specialized funders or even like credit cards. But let's just focus on specialized Amazon funders for now, who are going to do revenue-based loans, MCAs, cash advances, things like that. And they're going to be expensive, but they're going to be expensive because you're a smaller business, and you're just a riskier investment. So part of that is, these investors trying to get alpha and get a better return out of investing in Amazon sellers. But another part of it is, they also have a much higher default rate. So if you're investing in a smaller Amazon seller, there's a higher chance that they're going to go out of business or just disappear. So they also have to make up for those losses by charging a higher rate to everybody. So that's like kind of the first group, though, are going to be people like that. They're mostly going to be wanting to take a lot of cash flow and take big payments every month or every 2 weeks, or in some cases every day, out of your business and just get paid back quickly. And that's basically how they also decrease their risk, is they take their money off the table really quick. So that's kind of like the first group. And if you're selling less than 100,000 a month or $1 million a year, like that's basically your option. It's going to be more expensive, and that's just how it is. But then once you get to about $1 million a year, and ideally closer to 5 million, you start to get access to a lot of alternatives. So there are some like private credit or private hedge funds that will invest, a couple million in a credit line. There are alternative lenders, and then even some banks that will invest in, sellers doing a couple 100,000 a month that have been doing it for a few years. So what they're usually going to offer is something like a 1 to 3 year amortizing loan or a credit line. And then their rate's going to maybe be advertised at something like prime plus 2 to 6%. So I don't know, prime's probably like 7% today. So like prime plus that. And then they're going to also have a bunch of additional fees. So usually we'll have an underwriting fee, a servicing fee, a minimum usage penalty, things like that, a prepayment penalty. And really their actual rate, that's not their advertised rate, and the rate on the top of your agreement might work out to something like 15 to 22%. And the challenge with these lenders, that's like a pretty decent deal for a small, what's considered to most financial institutions as a small business. Somebody who's doing 5 million a year is a pretty small business. And it's a pretty fair deal. And what that's going to come with, though, is that you're going to need to have, real solid financials. You're going to need to have a real defensible business position, audited or auditable inventory, and usually personal guarantees from the owners, which is pretty, standard for a multi-million-dollar credit line for a small business. The key challenges, I guess, with these lenders is you're going to have to probably provide monthly or quarterly financials and a borrowing base. So a borrowing base is something that looks at all of your inventory and your assets and basically proves the value of that asset so that they know that you're in compliance with the terms of your loan. They might have to send somebody, sometimes a third-party auditor, to your warehouses to do inventory counts. And then most of these lenders aren't connected to Amazon's API, so I've seen people trying to get money from these banks or alternative lenders and go through a 6-month process of providing documents and basically explaining how their business works. And then they're also mostly going to require monthly payments. A lot of times if it's a credit line, it'll be interest only, which again is like a great deal for a $5 million business. So that could be, on a $2 million loan, maybe $25,000 to $50,000 per month in interest payments. So I think, kind of the key takeaway and difference there is that we also have Accruemy. So we basically offer the same rate as these alternative banks, in the mid to high teens. But we can underwrite you, in a couple days. We track your business on a regular basis, so you don't need to send us financials and do borrowing bases. We don't need to send auditors to your warehouses. And then we also don't require any payments. So, you might be making $25,000 to $50,000 in interest-only payments on a credit line like this. And with us, you don't have to make any payments at all, 0 payments coming out of your business and 100% going back into investing in your growth. So that's probably the key takeaway really is that if you're under 100,000, it's going to be expensive. It's going to kind of be a drain on your cash flow. But if you really need the money, that's what you need to do. And then once you get over a couple million a year, you kind of graduate and you have a lot more options. And then it's really just a decision of how much work do you want to do to get all the documents together, or do you want to just have it automated through our private capital program.
Excellent. And I think one of the keys with Accruemy is that you don't require any payments until 36 months later, right?
Mm-hmm. Okay. Yeah, so, and that's, because we can see, unlike a bank, for example, we can see all of your data in real time because we connect to your store through APIs. So we're right. Comfortable letting all the money roll and just reinvest and let you grow. Where a bank, they don't invest in a lot of Amazon sellers. They invest in brick and mortar stores. They invest in all kinds of stuff. So they just have their rules, and they are going to want to get repaid, on the same schedule that everybody else repays them on. And I think that was also, something with that example I gave you with the person sourcing in Brazil. If you think of this like a credit line, they were basically at the max of their credit line. Let's say they had a $1 million credit line with us, but we were able to just see everything that was happening with their business and decide to make an exception and give them an extra 500,000 so that they could kind of beat the tariffs and get their inventory here before the August 1st deadline. So that's another thing that gives us a lot more flexibility than a bank, where if you went to your bank and said, I need you to basically increase my credit line by 50%, they probably want to re-underwrite your entire business.
Yeah, yeah. So it sounds like Accruemy also understands sellers better, like the nature of the business and the fact that you're, hooked up to the API, so you can see all of the inventory and all the sales coming in and out and all the details, right?
Mm-hmm. Yep. Exactly.
Okay. Excellent. So Ben, how can Accruemy help if people want to connect with you guys to learn more?
Yeah. So I guess what we can do is if you just go to app.accruemy.com, really for people who are selling between 1 million and 25 million a year on Amazon, if you go to app.accruemy.com, we will probably be able to either match or beat any bank or private credit terms, and we'll be able to blow most specialized terms out of the water. So if you go to app.accruemy.com and tell us that Gary from Seven-Figure Seller Summit, or just put Gary W or Gary or 7FSS in the how you heard about us, we'll know you came from Gary. And if we get you funded before August 31st, we'll waive your first 30 days of all interest, costs, and payments. So you're basically going to get free money for 30 days after we fund you. And we'll also give you, the best terms basically out there.
Excellent. So if you are interested, if you're selling 7 figures or above, right? If you're selling on Amazon, are we talking just private label, or are we talking retail arbitrage or wholesale, or what are we talking?
So we prefer brands who are doing private label, but if you are doing a wholesale model, we don't really like retail arbitrage, but if you're doing a wholesale model and buying directly from the brand, or you have a brand exclusive, or at least the brand knows that you're selling and you're authorized to sell, then we want to talk to you. But if you're just buying, from closeout wholesalers, then that's not really a good fit for us.
Okay. And what about, let's say, private label brands? What about like Shopify?
So we're actually right now just launched Shopify, and we're in the process of adding TikTok Shop as well. So if you're selling on Amazon, a lot of the larger sellers in general are selling on multiple channels. So we'll take all of that into consideration when looking at your funding. Usually we focus on Amazon to start, so that's what you'll see when you go through the application process. And then if you just tell us as you're going through it that you're on Shopify or TikTok Shop or any of that stuff, we'll just send you another link so you can connect us to those, and then we can add all that into your profile and take a full look at your business.
Okay, perfect. So if you guys are interested, definitely go to app.accrueme.com and then enter in Gary or 7FSS, and then you'll get the special bonus. 30 days, no fees, no payments. Is that correct, Ben? I don't want to say something that I shouldn't have said.
Yep, that's exactly it. 30 days of no cost at all. So we're not going to start charging you any interest. You're not going to have to make any payments. It's just basically a 30-day free trial, essentially, free money. So
okay,
perfect. Deal if it tells you it came from you.
Okay, perfect. So just to be totally transparent, I am a partner of Accruemy. So, I've been working with them for a number of years, ever since the pandemic, and I've seen a lot of success stories. So if you do go through me to get the loan successfully, I will get a small commission that helps, pay for my coffee. I need my coffee to keep me going. So just to be totally transparent, if you don't want to mention me, that's totally fine as well. My mission is to help sellers out there to grow your businesses this year. That's why I wanted to bring Ben on for the value that he just shared. So thank you for that, Ben. To close out, can we do a quick lightning round? Is that cool?
Sure. Yeah.
Okay, on a personal level, Ben, what do you do to stay ahead of the game?
I like to read a lot and probably listen to a lot of podcasts and just learn from different perspectives and see get a broad landscape of everything.
Okay, that's the second question. Favorite book or podcast you'd recommend?
Ooh, favorite book or podcast. So right now, I got a book that I read recently that I really liked was, I think it's called Wisdom of the Bullfrog, or From the Bullfrog. It's from Admiral McCraven, I believe this is the author's name. So he's an admiral Navy admiral, former Navy SEAL, and he kind of has his tips for leadership based on his career, and I thought that was really good. And then a podcast that I've been listening to a lot that I know has some people love it, some people hate it, but has been the All In podcast. I don't know if you know that one, but they've gotten a little bit more political lately, but I've been listening to that one a lot. So those are my looking at pod for you.
Perfect. And you're based in Mexico City. What's the favorite thing about Mexico?
It's got to be the food, tacos.
You're making me hungry, man. We don't get good tacos here in Japan. I have to see when I can book the next flight. Okay, last question. 80-20 rule. I'm all about the 80-20 principle. So if you were to distill down everything you covered today, what would be the number one recommendation for sellers out there? Besides sign up for Accruemy, obviously.
I think the number one thing is just to understand your financing and take a second look at it yourself rather than listening to whoever's trying to get you to take the financing and explain it. So, what I've even done with sellers who've come to us is they give us an agreement that, we say we'll match it or beat it. And I just put it into ChatGPT and basically say, explain to me what the actual APR of this is when you take everything into account. And then you realize what you're actually paying and what the actual deal is. Because a lot of times, it's the terms that are advertised are very simple, and the document's very long and complicated, and as a seller you want to understand what's actually happening, not just what they want you to believe is happening. So
that's genius. Yeah, that's genius. I love putting all of that like legalese, APR language into ChatGPT. Explain to me as like a 10-year-old, right? But fact check that, guys. Don't just trust it to be your financial advisor. All right. Ben, thank you so much for coming on today. This has been super valuable. Highly recommend you guys check out Accruemy if it is a good fit for you guys. And good luck out there. We'll see everybody at the next session. Bye, everybody.
All right. Thanks, Gary. Bye, everyone. All right.